Every government tells you the same story. Your money is safe, your bank is sound, your economy is open to the world. You're told you can move your money freely, invest where you want, pull it out when you want. That's what freedom of capital supposedly means. You work, you save, you trust that if something goes wrong, you can just move your money somewhere better and protect yourself. But history has a much colder version of that promise. Again and again, people wake up one ordinary morning and discover a small detail no one mentioned in the brochure. Those doors only swing one way. Your money is always welcome coming in. Leaving is another matter. In Argentina, in Greece, in Cyprus, in Lebanon, in Iceland. In dozens of crisis moments you never heard about in school, people tried to move their savings, shift them out of a collapsing system, convert them into something safer, and ran face first into invisible doors they never knew existed. Capital controls. Not printed on your debit card, not advertised in the bank commercial, not mentioned in the open for business speech. They only appear when you try to walk out. Most people hear the phrase capital controls and their eyes glaze over. It sounds like a boring technical detail in an economics textbook. But if you strip away the jargon, capital controls are simple. They're locks, not on your front door, on your exits from the financial system. They decide whether your money is truly yours or only yours on paper. They decide if you can move your savings across a border or if they're going to stay exactly where the system needs them, no matter what you want. If that sounds extreme, history has a blunt answer. Yes, governments do that, over and over again. This is the territory where money, power, and history collide, and nothing is as simple as it looks. Capital controls aren't just boring legal rules. They are emergency levers built into the architecture of modern finance. You're not supposed to notice them. You're just supposed to discover them too late. To understand how we ended up in a world where money can circle the planet at the speed of light, right up until the second your government panics, you have to go back. Not to crypto, not to 2008, but to a time when capital controls weren't an emergency tool. They were the default. For most of human history, capital didn't move quickly. If you were a wealthy merchant in the Middle Ages and you wanted to shift your fortune from one kingdom to another, you couldn't click a button. You packed chests of silver or gold, hired guards, bribed border officials, and prayed you didn't get robbed on a mountain road. Distance and danger acted as natural capital controls. The world didn't need complex rules to stop your money from fleeing. The physical world did that automatically. That started to change with the rise of modern banking, telegraphs, and railroads in the 19th century. Suddenly, money could move faster than people. You could have deposits in London and Paris. You could wire funds using telegram codes. Capital finally became what it is today, restless, mobile, and nervous. And something new appeared, capital flight. When a government looked shaky, when war clouds gathered, when a currency started to wobble, the richest and most connected no longer had to sit and hope. They could quietly move their money out. They could sell local assets, convert into safer currencies, move funds to safer banks. Those who couldn't move stayed trapped in whatever came next. Governments noticed. By the early 20th century, under the gold standard, countries promised their currencies were as good as gold. On the surface, it looked like a world of hard, honest money. Underneath, capital flows surged dangerously from boom to boom. When trouble hit one country, money sprinted for the exits, putting enormous pressure on its banks and currency. Then came the Great Depression in the 1930s, and the illusion is shattered. Countries devalued their currencies. Banks failed. People lost savings. And as panic spread, governments realized something terrifying. If everyone is allowed to rush for the exits at once, the entire financial system can collapse in a matter of days. So they did the simplest thing imaginable. They started locking doors. In the interwar period, exchange controls became common. Governments limited how many foreign currencies you could buy. They restricted gold exports. They made it harder to move money abroad. To the average citizen, it looked like bureaucracy. To the system, it was survival. After World War II, when the world tried to rebuild, the architects of the Bretton Woods system understood this perfectly. On paper, they created a neat arrangement. Currencies would be pegged to the US dollar. The dollar would be pegged to gold. Trade would be encouraged. Global institutions would promote stability. But there was an unspoken tension. Free trade and completely free capital flows don't coexist peacefully in fragile economies. If money can move anywhere, anytime, a small country's financial system can be torn apart by panic in a week. So most countries did something quietly rational. They kept capital under control. You couldn't just move large sums of money across borders without permission. You couldn't convert unlimited amounts of your local currency into dollars whenever you felt like it. There were licenses, approvals, and limits. The doors existed, and everyone could see them. The logic was straightforward. If you let capital run wild, any small shock can become a stampede. So you don't let it run wild. You build fences. It worked, more or less, for a few decades. Then, in the 1970s, the system cracked. The United States closed the gold window. The dollar stopped being redeemable in gold. Currencies began to float. The new ideological fashion arrived. Deregulation, liberalization, free markets. Capital controls were declared old-fashioned, backward, a sign you weren't serious. The future supposedly belonged to open financial borders where money could race around the world 24/7, chasing returns. Country after country opened its doors. Some did it willingly to attract investment. Others did it under pressure from creditors, international institutions, or trade agreements. Financial centers grew. Offshore hubs blossomed. The message was clear: bring your money in. We are open. We are modern. No restrictions. No worries. For decades, this seemed to work. Foreign capital flowed in, buying bonds, stocks, and real estate. Governments enjoyed cheap borrowing. Banks grew. Politicians pointed to rising markets and said, look, it's working. But the architecture hadn't really changed. The doors still weren't symmetrical. Money flowing in was celebrated. Money trying to leave in a panic was treated like a threat. And that's where capital controls come back into the story. They almost never announce themselves, honestly. You don't see a headline saying, from today, your money is partially ours. Instead, they arrive wrapped in soothing phrases, temporary measures, extraordinary prudence, emergency tools for stability. In practice, they can be brutally simple. Your bank suddenly limits how much you can withdraw each day. The government caps how many dollars you can purchase per month. Large overseas transfers require special permission that never seems to come. A new tax appears on foreign transactions that makes moving money prohibitively expensive. An official exchange rate appears that nobody really uses, while a black market rate tells you what your money is actually worth. On paper, this is policy. On the street, it feels like this. You walk into your bank, ask to withdraw your savings, and someone behind the counter smiles and says, you can have a little, the rest has to stay, for stability. One by one, countries provide case studies. In Lebanon for years, banks paid high interest on deposits, attracting dollars from citizens and the diaspora. On the surface, it looked like a stable system. Then the underlying reality surfaced. It was unsustainable. When confidence broke, banks simply froze deposits. People discovered their dollars were not really global dollars anymore. They had become local digits, trapped in Lebanese banks, subject to withdrawal caps and silent haircuts. The door had always been there. People just didn't know it was locked from the inside. In Cyprus, during the 2013 crisis, savers woke up to find that deposits above certain thresholds would be partially confiscated to rescue the banking system. Withdrawals were limited. Overseas transfers were controlled. The idea that your bank account was simply your money dissolved overnight into a new reality. Your money was part of a system, and the system came first. In Greece, during the 2015 sovereign debt crisis, people lined up at ATMs as capital controls, limited cash withdrawals, and blocked most foreign transfers. Businesses couldn't pay suppliers abroad. Individuals couldn't safely move savings out. The message was clear. You may have worked for this money, but in a crisis, the state decides how fast you can touch it. Argentina has turned capital controls into a recurring chapter of national life. Periods of apparent openness are followed by strict controls. Multiple exchange rates appear. One price if you change money officially, another if you use the black market. Rules shift. Today you can buy a limited amount of dollars. Tomorrow you can't. Many Argentines live with an unspoken assumption. Whenever things look fragile, assume the door might close soon. Sometimes capital controls are imposed early and deliberately. During the 1997 Asian financial crisis, Malaysia famously defied international opinion by imposing strict capital controls to stop speculative attacks and stabilize its currency. For that, it was heavily criticized at the time. Years later, some economists quietly admitted the move had helped the country avoid an even deeper disaster. Sometimes they're imposed late and clumsily after years of denial. By then, insiders have already moved their money. The door only slams shut once ordinary people head for it. The pattern is brutal and consistent. The doors never close for everyone at the same time. They close for the last ones in line. Why do governments do this? If you ask them, the answer is always the same. Stability, order, the common good. Without controls, they argue, a wave of panic could destroy the banking system, crash the currency, and wipe out even more wealth. Better to slow the rush, manage the outflows, buy time. From the system's point of view, that logic makes sense. If you designed a fragile structure and saw every person inside running for the emergency exit, you would do whatever you could to slow them down. From your point of view, trapped in that structure, the experience feels different. You did what you were told, you worked, you saved me, you trusted the system. And at the exact moment you decide to protect yourself, someone else decides your money has a new role. It has become collateral. Capital controls reveal a truth people prefer not to think about. Your wealth lives inside a jurisdiction. It is not floating in a vacuum. It exists under a particular set of laws, managed by particular institutions, run by particular people. When those people feel threatened, your freedom becomes negotiable. So what actually survives when capital controls slam shut? Not all money is equally easy to trap. Local bank deposits are the easiest. They live entirely inside the system. A government decree, a central bank rule, a bank policy, any of these can freeze or ration them. You still own the number in theory, you just can't use it in practice. Local currency is fragile. It can be inflated, devalued, redenominated. Its value outside the country can evaporate even if the number in your account stays the same. Harder to trap are assets that exist outside a single jurisdiction's easy reach. Property or accounts in multiple countries. Assets already in a more stable currency. Ownership structures that don't depend on one legal system. No asset is untouchable, but some are more resilient. Harder still to trap are things no decree can seize. Skills, productive capacity, the ability to create value in more than one place in more than one way. Capital controls don't invent a hierarchy of vulnerability. They simply expose it. At the bottom are those whose wealth exists as a single line on a local bank statement under one government's thumb. Above them are those with claims on multiple systems. Above that, those who hold real assets that retain value even when a currency doesn't. And above all, those who understand how doors work and move before everyone else notices the smoke. The lesson isn't that every country will impose capital controls tomorrow. Most won't. Many never will in your lifetime. The lesson is that your wealth faces more risks than the ones you see on a stock chart. You're taught to think about market risk, investment risk, credit risk. You're told to diversify across asset classes. A little cash, some bonds, some stocks, maybe real estate. You are rarely taught to think about jurisdiction risk. What happens if the rules change? What happens if the promise of free movement becomes conditional? What happens if, at the exact moment you decide to leave, the door decides it only swings one way? We live in a world that glorifies returns and ignores exits. People brag about their gains. They study charts, hunt for yield, chase the next big trade. Very few ask a simple question. Can I still move if the game changes? In good times, capital controls look irrelevant. They're dusty clauses and forgotten laws. They're tools nobody uses. Politicians talk about freedom, global integration, open markets, and opportunity. You can wire money instantly, trade currencies on your phone, move assets at will. Then a crisis hits and the vocabulary changes. Overnight. Temporary restrictions, emergency measures, extraordinary prudence. The door hasn't changed. You're just finally discovering which way it really swings. Every empire swears its money is safe. Every government insists your savings are secure. And every time a crisis hits, history quietly adds a footnote. Your wealth does not live outside the system, it lives inside it. Capital controls are the system reminding you of that fact. So the real question isn't, will my country ever impose capital controls? The real question is more personal and more uncomfortable. How much of your life depends on doors someone else can lock without asking you first? If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.